My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job's not just to entertain, but to teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. In a bull market, there is nothing worse than watching the averages roar higher while your portfolio just sits there barely moving. It makes you feel like a complete dope, doesn't it? Like the stock market, it must be some sort of total shell game. But really, it just means you might be making a few basic mistakes. That's why tonight I'm devoting the whole show to my playbook for taking advantage of a short-term rally, not to be confused with a so-called bear market rally, which is a bogus term people throw around whenever stocks go up at a time when the intelligentsia thinks they should be going down. Sell. Yep, I want to give you my game plan for handling short-term gains. Now, I know what a lot of you are thinking. What kind of incompetent doofus needs a guide to make money in a rally? What's next? Is Cramer going to draw us a diagram explaining how to pick your nose? I mean, mad potty training? Should I just start reading picture books to children? Hey, we've already got the animal sound effect, and reading rainbows has been off the air for more than a decade. Maybe you feel like that's the same level of difficulty as making money when the stock market's on fire. Who needs help when the Dow's up hundreds of points in a day, or even better, during a multi-day rally, a real run, a buy fest? Do you really need my advice to help you deal with huge profits? No, I'm not buying into that biggie smalls theory of investing, mo money, mo problems. But knowing how to approach a quick run the right way can make you a better investor. And tonight, I want to teach you some of the discipline that we demonstrate for the CNBC Investing Club all the time. Sure, everybody makes money in a big rally. It can even feel like your portfolio's running itself, doesn't it? Doesn't it feel like that? But I'm not here to talk about how to make the most money possible when the market's up big. Honestly, not that crucial. No, the most important lesson for dealing with a major short-term move higher is that you always have to work hard to prepare yourself for the future. Otherwise, you'll end up letting some great opportunities to sell pass you by. Sell. That's right. Just as we can't give in to despair when the market's down, you simply don't want to give in to euphoria and buy when the market's roaring. That's not when you should buy. It is when you should be taking some chips off the table. Remember, you don't actually have a profit until you sell something. You aren't making money until the register is rung. And the idea that you should buy and hold through both the best of times and the worst of times has proven to be incredibly foolish, with only very few exceptions. You need to use strength to lighten up, particularly on stocks of companies with deteriorating fundamentals. That's why I always insist you do your stock homework, because how else will you know what to unload? If you don't want to do it yourself, you know what? You can join our club, the CNBC Investing Club, and we do a lot of the homework for you and with you. Why is it so hard to sell to strength? Good question. Let me put it this way. Nobody wants to miss a rally. If you sold every stock you own right before a huge up day, you'd feel like a stooge. Not even Larry, Curly, or Mo. I mean, maybe the dreaded Shemp. Let's look at it another way. Say you're in stocks for the rally and you have massive gains, but you don't do anything. You let them ride, so to speak. And then gradually, or maybe not so gradually, your stocks come back down. If you hang on for too long, if you let your gains ride until they evaporate, how is that any different from missing the entire rally? It isn't. Making lots of money on a great day or a great month or a great year is wonderful. But you can't view a rally as just a day or a few days where your portfolio went up in value and nothing more. You need to see it as a time to take action. Even if you don't fancy yourself a trader, and try not to time the market. Even if you're like that, and I encourage you to be like that, you have to make an exception for some very good but sharp up rallies. That's what I'm talking about. Just as you need to remember the good days during the sell-offs to keep yourself in the game, you need to remember the down days when the market's roaring to keep yourself tethered to reality. Don't pass up an opportunity to trim your positions just because you're in stocks for the long haul as an investor, not a trader. I'm not telling you to blow out of the positions. That's not what I'm saying. I'm talking about doing some sell. Being an investor does not absolve you of the need to have judgment. In other words, you should approach every rally with a grain of pessimism about what's coming next. That shouldn't be that hard. Think about this. Think about like the post-COVID meltdown in 2022. Not many wanted to sell in late 2021. It looked too great, right? Because we had an unbelievable bull market where buying the dips made you a fortune. But then the Fed declared war on inflation, and those gains disappeared. If you had sold stocks gradually on the way up, as I told you to do, you were in much better shape as the market spent the next 11 months just getting obliterated. There's nothing wrong with feeling good about a rally. Someone with some violent mood swings that happen to reach for that cheap scotch lying on a dirty linoleum floor when you get that really bad tape can tell you. I recognize the value of celebrating your stocks when times are good. Euphoria is fine as long as it doesn't lead to complacency. Complacency is your nemesis. On a big up day, you can be thrilled. You just don't forget that you're getting a terrific opportunity to lighten up with some of the stocks. That's what short-term rallies are for. But it's very easy to be swept away by the positivity. When the market's up and everybody's optimistic, the last thing people want to do is sell. Once you believe in the market again, when everything seems wonderful, how could you ever want to sell a stock? In theory, we all know we're supposed to buy low and sell high, but in practice, that can be a lot harder than it sounds. This is why we constantly teach you the discipline of selling into strength when you join the club, because we do it all the time with the charitable trust. We peel some off. Look, I know the feeling. You're sitting there watching the gains roll in, and you feel like selling some stock would be the most insane thing in the world, because what happens if the rally keeps going? Doesn't matter. We sell into strength. But we also never sell all at once. That way, timing is less of an issue. Take some off, and if the rally holds up, well, you can sell more later. The name of the game is preparation. While there's no real way to prepare for a rally other than by owning stocks, you can use a rally to prepare yourself for potential down days in the future. It's a little counterintuitive, but it works. The best time to adjust your portfolio like that is when stocks are going higher, not when they're going lower. Think about what you'll need if the market goes south, and consider what you can do for your portfolio today, the day of the rally, that you couldn't do yesterday. The simple answer is that you can sell part of a position and take advantage of higher prices. Remember, we never ever buy or sell all at once. That's not my style. But on big up days, you can sell in larger increments. In the rest of the show, I'm going to go through the whole Mad Money rally playbook and explain what to sell, how to sell it, and why you're selling it. But right now, here's the bottom line. When the stock market's had a big short-term run, don't get carried away by the optimism. Instead, keep your head on straight. Check your emotions. Focus on the long term. And think about ringing the register, especially on stocks that might be getting too high. More on that later. Let's go to Michael in Pennsylvania, please. Michael.
Hey, Jim. Booyah. This is Michael in Philly Burbs. Hey, I'm looking to sell my house for about $500,000, and I'm buying a new place for about $350,000.
Okay.
And by the time I'm all done, I'm probably going to have $100,000 to invest for my retirement,
Oh,
which
I think that's
have
terrific.
next to nothing.
That's terrific.
I'm looking to do, what do I do, short-term high growth, and what do I do long-term dividends, like
Okay. Now, I got to tell you, I am in a different camp from almost everybody else. I want to bet on my long-term life. I want to be able to say, look, I think I'm going to live long. All the longevity statistics are very good. I think Larry Fink agrees with me on this. He's the great CEO of BlackRock. I think that you should be buying dividend stocks. I'm trying to urge you to not move into cash. Dividend stocks are a great way to protect yourself. Try to pick ones that are 4-5%, and I think you'll do very well. And you can do it yourself. I know you can build this. Steve in Kansas, please. Steve.
Booyah, Jim. How you doing?
I am doing well, Steve. How about you?
I'm great, and thanks
Terrific.
for taking my call.
Sure.
Hey, Jim, by the way, Andy Reid says number 3 this year.
I love Andy Reid. What can I say? Coach Reid's the best. Coach Tammy Reid's unbelievable. What a great family. How can I help you?
So, Jim, I'm heading into retirement at the end of this year, and I have been investing all my life. I'm 100% equities, no bonds. At the beginning of 2022, I moved about 40% of my portfolio into value. So I'm a 60-40 split growth value. I've been big growth all of my life for the most part. What is your opinion about staying with that type of split 60-40
Well, it's funny,
value?
Steve. It is right in my wheelhouse. I would not do a thing. I think you're doing it right. I was so afraid that you were going to say, I'm thinking about switching 20% bonds, 30% bonds. Look, the short-term rates are high. I get that. But I like how you're positioned because you're betting with your life, not against your life. And that's what I teach people to do. All right, when the stock market's had a big short-term run, please don't get carried away by your optimism. Instead, keep your head on straight, focus on the long term. But also think about ringing the register, especially on stocks that might be getting too high. And I know you own some that will be. On Mad Money Tonight, I'm giving you everything you need to know about market rallies with my Mad Money Rally Playbook. I'll show you how you can tell whether you're taking on too much risk. when you should use rallies to raise cash, and the things you should never do in a green tape. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
People always want help when the market sells off. They want me to tell them what to do, to validate their fears. When stocks get hammered, investors freak out. They panic, or at least they want to panic. I think that's right. I mean, I obviously don't want you to panic, but that's what people are doing. Many don't know what's going wrong. Few can easily handle the trauma of big losses. And even the smartest operators want some expert advice. But after more than 4 decades in this industry, I can't recall a single time when someone's come up to me and plaintively asked, Jim, the market's rallying like crazy. What the heck do we do? Hey, that's unfortunate, because just as you need a playbook to deal with declines, like I just mentioned, you also need a rally playbook, a guide that tells you what to do when the market's having a big short-term run. Not sell-off, but run. I know the received wisdom is that nobody wants to help with a rally, but you need to reject that idea that people only need help when the market's lousy. There are all kinds of mistakes you can make when the stocks are going higher. In fact, the rally playbook might be more important than the sell-off playbook, if only because so few people think they need one. So here's my first rule for handling a rally. Always be really, really, really tough on your portfolio, not just on the down days, but on the big up days. The only time you should be harder on the stocks you own is when you're in the midst of a brutal decline with no end in sight and the need to circle the wagons, meaning dump everything you aren't thrilled to own and use the cash to shore up your positions in the stocks where you have the most conviction. Obviously, that's a worst-case scenario. How exactly do you get tough on your portfolio? When you need to give every one of your stocks the harshest possible evaluation. Suspend the benefit of the doubt. Assume everything you own is guilty until proven innocent. Focus on the worst qualities of your stocks. Emphasize the downside. Make each and every company you own prove to you that it's worth holding all over again. If this strikes you as silly or even unfair to your fabulous stocks, allow me to explain, please. On a good day or a good week, you're ready to fall in love with your positions because they made you so much money. That's typical, but it's also a mistake. You can love your spouse, you can love your kids, you can love your pets. I like one of them. You can love your country. You can even love your car, just as long as you don't become enamored with your stocks. Silly pieces of paper that you bought for the sole purpose of making money. They're not going to love you back. In fact, when we're in the midst of a big rally, you really shouldn't give your stocks too much credit for making you money unless they dramatically outperform the rest of the market. Yet even then, you need to give your stocks a hard time. When a stock makes you a fortune, the normal reaction is to like that stock or like it more. However, think about this. Most of the time, you should like it less for the simple reason that stocks get more expensive when they go higher. During a major market-wide rally, unless there's some serious value-enhancing good news, your stocks become pricier and therefore less desirable. If you didn't own them, you know this, right? When you look at it, oh, that stock's up too much. For example, no matter how much you like Microsoft, the company, and I do, Microsoft, the stock, is a lot more attractive, say, at $250 than it is at $350, correct? In other words, in the wake of a big up move, your entire portfolio just got less attractive. Like I constantly explain to members of the CNBC Investing Club, price matters. And when a stock price goes up, the risk-reward becomes worse, okay? Valuation makes it more volatile. You made money, which is what we're after. But you can't let that prejudice you in favor of any particular stock. Just like blackjack, the cards have no memory, people. While your stock may have gone up when the market was roaring, that doesn't have much bearing on where it goes tomorrow, does it? The second reason to get tough on your portfolio during a rally is that you can figure out which ones to sell and sell hard. I tell you to sell in the strength all the time, but I recognize this idea is totally contrary to human nature. In a rally, everyone else is buying like crazy. You feel great about your stocks, and you certainly don't want to sell. But you have to, because there's no better time to sell than during a major short-term move higher. Oh, and by the way, this selling doctrine applies to everything, even mutual funds. If you have gigantic short-term gains, it's okay to ring the register on some of them. I like that. Again, we all know this is true on some level. We know buy low, sell high. But that's hard to execute in the moment. You have to, though, because the facts have borne it out for years. Even as nobody likes being told to sell a winning stock into a smoking hot rally. So how do you fight your instincts? How do you get to a place where you can sell in spite of your emotions? Simple. Just like I said before, you get tough in your portfolio, reevaluate your stocks, and demand a lot more from them than you normally would. Especially since they're more expensive than they were the day before because they went up. Now, I've got a very specific way of grading my stocks that I've used since my hedge fund days. Every week, I rank the stocks in my charitable trust, which you can follow along with by joining the CNBC Investing Club, which I urge you to do. I rank them from 1 to 4. Ones are stocks you would buy at their current price. Twos are stocks you'd buy if they pulled back. Threes are stocks you'd sell at a higher price. And fours are stocks, well, let's say you don't want to take any action on it without more information, period. And when it comes to this ranking system, a rally has a way of simplifying things. Prices are up, so the former ones, stocks that were worth buying at their current price, suddenly become twos, stocks only worth buying on a pullback, because most things will have gotten too expensive. Get this? Better to keep your powder dry. Wait for a sell-off down the road before you do any more buying. Meanwhile, a lot of your threes, stocks that you wanted to sell in the strength, become fours, stocks you don't want to take any action without more information. Now, this is just a preliminary approach to what you should sell in a short-term rally. I'm going to give you more details later in the show. The reason we rank our stocks like this is to keep our emotions in check. We understand that we're frail, okay? So we buy low and we sell high instead of buying high just because it feels good at that moment. Most people, for reasons we don't have time to go into, now at least, really enjoy buying stocks, but see selling them as a defeat. But ringing the register is not a defeat when you're getting top dollar prices during a juicy rally. First, though, you have to put yourself in the sell mode, and you start doing that by getting tough on your portfolio. Bottom line, during a big up day and after, don't get swept away by euphoria, okay? Don't listen to the buy and hold doctrine that says it's not worth it if you actually want to buy it. Book a little profit on some merchandise, because the whole point of owning stocks is that you're supposed to sell them when they go higher to make money. If the fundamentals aren't changed, if the company hasn't improved, then it might have gotten too expensive as a stock because of the rally. So when the market's roaring, give your stocks a hard time, please. Hold them to a higher standard and ring the darn register on some of the stuff, both of the names you like the least, and of course even the ones that are up the most. Mad Money's back after the break.
Coming up, want to preserve those profits after a big rally? Cramer's revealing the next chapter of his playbook and how to build the most important part of every investor's portfolio. Next.
Booyah for the Emperor of Cramerica.
Honorable James J. Cramer.
You got me jumping around my office right now.
Thank you so much for all you do for us.
I enjoy your show and I find it very entertaining and informative.
I watched your first ever episode of Mad Money back in 2005, and I've been watching every single episode ever since.
Don't miss Mad Money every night at 6 p.m. Eastern. Plus, join the CNBC Investing Club and stick with Cramer around the clock. Scan the code, shop the tank. Tuesdays, 9 Eastern, CNBC.
Tonight, we're diving into the Mad Money Rally playbook, teach you the disciplines that will let you take maximum advantage of a big up day. Over and over again, I've been telling you that short-term rallies are opportunities to sell, not buy, extolling the virtues of something that may sound really obvious, but can be hard to put into practice because it runs counter to what our emotions say we should be doing when stocks are roaring. Of course, most people don't like to hear about selling stocks, except when they're panicked and they think the whole world's falling apart. Then they want to be given permission to sell, as they want to sell everything, even though that's almost always a mistake. Generally, most investors want to know about buying, especially what to buy. But you know what? You should have a plan for selling every single one of your stocks, even the best ones. And you should make that plan before you ever purchase them, simply as part of the process. Being a good investor means knowing when to get out, and it's better to make those decisions beforehand rather than waiting until the heat of the moment. Of course, we always want things to stay and never have to sell, but you know what? Listen to me on this. Stocks of good companies can get too expensive. It happens all the time. In a big rally, stocks of bad companies also get too expensive. But it's easy to sell something when you know it's bad, isn't it? Much harder to unload something you genuinely like for legitimate reasons. For example, in 2021, we had a spectacular rally in fast-growing cloud-based software stocks. The whole group got too expensive, but the low-quality speculative names with no earnings and the higher-quality established companies with great numbers, well, they all went up. And that includes many Cramer faves like Salesforce and ServiceNow. They got too hot, and you had to sell them into strength because after the Fed declared war on inflation, the cloud software cohort spent the next 11 months getting mauled. Oh, the profit ones held up a lot better, but their stocks still got eviscerated. And you could have sidestepped much of that pain if you simply rang the register on the way up. Now, let me make this clear. Selling into a rally is not solely about turning a profit then and there. Obviously, we're looking to buy low and sell high. So a big up day or two gives you a great chance to sell. But the best reason to take some profits or cut your losses during a rally all boils down to what I talked about at the beginning of the show: preparation. Let me explain. I believe you should be prepared for the bad days down the road. Maybe because I'm a glass half empty kind of guy, except, of course, when I'm being a glass half full kind of guy. But mostly because the bad days are just as inevitable as the good ones. And what's the best time to get ready for these inevitable down days? How about during or right after a big up day? That's the perfect moment to take something off the table, raise some cash. In other words, a short-term rally is your best opportunity to protect yourself from potential downside. Trust me, you get the most mileage out of preparing for the worst days on the best days. Don't get me wrong. That doesn't mean you should sell everything into any kind of strength. That would be self-defeating. It doesn't mean you should believe that all rallies are ephemeral and not to be trusted. You know, there's an army of strategists and billionaire money managers and commentators who are constantly eager to convince you that every up move is temporary or even illusory. Alchemy. They want to scare you. I am not one of those. I know that plenty of rallies have staying power and can take you higher and higher, in true Jackie Wilson style, perhaps without that Latin casino event. You can believe in a rally and still use a big up day to take some profits, though. That's how you get ready for days in the future that likely won't be good. There's no cognitive dissonance here. We're just trying to balance the concept of capital preservation, the need to keep your money secure, with capital appreciation, the need to grow your money. Both of these are pure necessities, and they're not always mutually exclusive. You use a rally to take a profit so that when the market comes back down, you'll have cash on the sidelines, cash you can put to work buying stocks that have been suddenly put on sale. So in a way, the rally playbook is really an extension, really more of a prologue to the sell-off playbook. We use the rally to stockpile everything that we'll need in case things get bad, and one of those things is cash, glorious cash. Yep, while I'm a citizen of the United States, I always pay my respects to the one true king, which is cash. Play-Doh cash is probably the single most important part of your portfolio. Most of the home gamers I talk to do not know this. I hear from people all the time who tell me they're fully invested, meaning every dime of their money that's earmarked for investing is parked in stocks. And whenever someone tells me that, they always think it's a good thing. Cash, my friends, is what makes everything else possible. Back in my old hedge fund, I would never, ever have less than 5% of my portfolio in cash, and I try to get it up to 10 if I could, especially after a nice run. Cash is flexibility. When the market pulls back, giving you an opening to start a position in a stock you like or to buy more of one you say you already own, you need to have some cash on the sidelines in order to do your buying. Otherwise, you have to sell something you already own on the fly or use margin, meaning borrow from your broker. And that's something I never recommend doing. It's too risky. Hey, speaking of margin, a big rally gives you the best opportunity to get off margin and start investing like a sane person rather than someone with a financial death wish. What's this got to do with responding to a rally? While we'd like to be heavily invested with a little cash before the rally, trying to call one in advance is too difficult. But the best time to raise cash, which many of you absolutely must do if you're fully invested, and the rest of you should want to do, is right after a giant move up. This is why we always have some cash on the sidelines at Charitable Trust. Here's how I think of it. Your portfolio's cash position is like your car's gas tank. If you don't have at least 5% cash, then you're running on empty. And you better fill her up the next time you get a chance to. Whenever you sell to raise cash, and we'll talk about that after the break, you'll get a much better deal after a rally. But listen, I'm not saying that rallies are a great time to go into all cash. Not at all. I'm saying I believe it's essential to raise some cash during or after a rally. Emphasis on some. Really, that's the goal. I don't care how much you like your stocks. Not selling something to raise cash when the market's making it easy for you is downright reckless. With the Charitable Trust, I've taken my cash position at times up to around 20%. When I sense too much euphoria. When the market eventually pulled back, put that swing cash back to work in stocks we liked a lot more than the ones we previously sold. Even so, the quality of companies you own isn't enough part of the equation here. It isn't part of it, actually. It's the price of the stocks that matter. And some will get very extended in every rally. So trim them, and you can buy them back later lower with the cash you raised from selling. That's the entire point. The next time things go sour, you'll have that terrific pile of cash you've hoarded up during the rally. You'll feel great. You'll be able to buy into weakness. You won't feel hampered like so many who don't do this. This isn't about getting a great deal, people. It's about protecting yourself. Bottom line, the next time we get a big up day or two, please, I'm begging you, use the strength to raise some cash. You might not know it, but without cash, your portfolio has zero flexibility. And the best time to raise cash is when the market is on fire. Let's go to Dylan in Virginia. Dylan.
Hello, Mr. Cramer. Thank you for your time today. As a finance student, I'd be grateful for any guidance you could offer students like myself as I prepare to enter the extremely competitive field of high finance. Thanks so much for your advice.
All right. Work hard. Work harder than everybody else. If you see everyone's coming in at 7, come in at 6. If they're working at 6, come in at 5. Be the last person to leave. Okay, I don't care what. Be the last person. Look around. If anyone else is still there, you stay later. That is what the bosses want to see. By the way, do some work while you're there. I mean, I don't want you playing solitaire. But work harder than everybody else. That's the secret. Oh, the work from home people? Ron in South Carolina. Ron.
Hey, Jim. How you doing, boss?
I'm doing well, Ron. How about you?
As best can be expected. Hey, I'm 70 years old. I have 2 retirement accounts, Roth and an IRA rollover.
Okay.
A couple years ago, I reduced my equities, $100,000 in each account, and bought treasuries, bought 30-day treasuries. And so my treasuries roll over every week. I buy one, they pay me. I buy one, they pay me. Well, I was getting ready to start thinking about getting into a little more back into equity.
Okay.
But with all this hoolah going on between the Fed and everybody's individual opinion, I'm kind of a little bit on the edge. What kind of advice can you give me?
Okay, Ryan, you are like many people in this position, which is that you kind of believe that you're earning so much money in your cash. Why should you risk being in stocks? So here's what you're going to do. You're going to wait till a down 7 to 10% move before you take off a quarter of your cash and put it in the market. Unless you get that decline, I don't want you to do anything. Stay where you are. Let's go to Linda in Illinois. Linda.
Hello. Booyah, Jim.
Booyah, Linda. What's going on?
Hey, it's so wonderful to talk to you. Listen, I affectionately call you Mr. Magic Money Maker because
that's
you
high
are
praise.
Awesome. Listen, thank you for your wisdom, and this is my question. I'm a retired postal employee who worked for 45 years. I have no financial investment knowledge. I wanted to know, how do I buy stocks? And I wanted to ask you, should I try to invest my thrift savings plan money in S&P index funds or Magnificent Seven or NVIDIA or all NVIDIA?
First of all, you're sweet to trust me. I do want you to start with your first $10,000 in an index fund. You'll buy it this following way. You will put, if you can, put a couple $100s to work each month. I don't want it in all at once, okay? If the market drops extensively, big, more than 10%, I want you to take the month that you would have bought 2 months from now and put it to work with that current month. That's how you're going to get the best basis. Stick by that discipline and don't go any faster. And then I'm confident you'll get good prices and not feel like somehow you got hurt. I love NVIDIA, not the right method of diversification. When you're facing a big up day, here's what I want you to do. I want you to use the strength to raise a little cash. You might not know, but without cash, your portfolio has zero flexibility. And the best time to raise cash is when the market is on fire, not when it's going lower. There's much more mad money ahead. You probably think it's good when your portfolio outperforms even on a big rally day. Well, guess what? You'd be wrong. Don't worry, I'm explaining why. Plus, I'm taking all your burning market questions with my Investing Club colleague, Jeff Marks. So stay with Cramer.
Good evening, Mr. Cramer. Thank you. Thank you for everything you do.
You've been such a wonderful source of information with your teachings. I have to say thanks.
Thank you for all your advice and saving us from ourselves.
Your advice let me quit a job that I hated. I love you to death.
Thank you for everything you do. Thanks for making us money. And more importantly, thanks for keeping us from losing money.
You're watching the Mad Money Rally Playbook, where I'm teaching you the best ways to take advantage of a market that's up big over a short period of time. Remember, that's crucial. Just a spike, all right? If you're just tuning in, I'm deeply wounded by the cold shoulder you gave me when you willfully chose not to watch me, or at least watch most of the show. I know you did it as a callous and sadistic attempt to hurt my feelings. Congratulations, it worked. I hope you're happy. Back to business. Most of my rally playbook has been about what you can do to benefit from higher stock prices. How you can use a rally to set up for the inevitable rough patches that the market runs into sooner or later by raising cash, and which stocks you should sell in order to do it. The last part of my rally playbook is a little different. It's not about what you can do during or right after a rally, which we've already covered. Instead, I want to highlight what a major move higher can teach you about your portfolio, because rallies are incredibly illuminating. I'm not too worried about anyone seriously underperforming the averages on a big up day, because that's something you can easily study and fix by getting more exposure to the sectors that were up the most. No, what should get you truly concerned is watching your stocks dramatically outperform the average. Dramatically outperform, that's the key word, in market-wide rally. You heard me right. Making too much money on a given day can be a problem, or at least a red flag, a situation where your gains are trying to warn you about something. It's very counterintuitive, but bear with me. The warning's very simple. When your portfolio leaves the averages in the dust on a day when the market's roaring, it means you're taking on way too much risk with your portfolio. I know I don't strike many of you as most conservative investor around. I get that. And the fact that I do this show every day, even though it probably doubles my odds of a heart condition, doesn't help my case. But taking on unnecessary risk in your portfolio makes absolutely no sense. And watching how your stocks move in a market-wide rally is a terrific way to figure out if perhaps you're taking on needless risk. Say the rally comes and you make much more than the averages. The question is why? Were you using margin, borrowing money from your broker to get that extra bit of leverage? That will help you crush the average in a rally, but it will also get you crushed by your losses in a sell-off. That's just not worth it, people. What else could cause your portfolio to dramatically outperform the benchmarks in a powerful market-wide rally? Well, it could be because you're not diversified enough. That's a way to make boatloads of money in a short time frame. Let's say the rally is led by tech, okay, and your portfolio is 50% tech. You'd be a big winner, right, for a day or two, but those gains are ephemeral. They won't last. Not only that, but the outsized profits are a huge warning, screaming at you to sell your darn tech positions. Maybe trim them back at least, and maybe call me up and play am I diversified. If you're not diversified, if you're keeping all of your stock eggs in one basket, then you could get wiped out in a heartbeat. Just ask all the investors who loaded up on cloud software stocks or electric vehicle plays before they peaked in November of 2021. Those people then got blown out. The whole business, they just got out with massive losses. They couldn't take it. They were all beating the stuffings out of the benchmarks in late 2020 and the bulk of 2021. They were making too much money. That's right, too much money, just like tech investors before the dot-com bubble burst in 2000. If they pay attention to this rule, something we remind you of constantly if you happen to be a member of the CNBC Investing Club, then they might have been able to avoid the damage from the hideous tech losses in 2022. They could have adjusted their holdings and lightened up on their biggest winners so that no single sector made up more than 20% of the portfolio. So let me give you the bottom line here. The best time to figure out if you're making too much money, meaning you're taking on a dangerous amount of risk, is during a big market-wide rally. Use these runs as diagnostic tests to see if your portfolio has too little diversification and too much risk, or if it's A-OK. Mad Money, be right back.
Coming up, have a fear of missing out? Cramer's giving you his guidebook on how to keep those emotions in check after a big run for the market. Next.
Booyah, Jim, I love you, man. I've been watching you from day one.
Thank you for all the wonderful advice that you provide us.
I'm learning so much watching your show.
Watch your program every day. I love it.
Always wanted to say booyah on your show.
Thank you for being the greatest in the world.
We consider you the money market maker, and we thank you for all you do.
I love your show.
We're longtime fans of your show, and we think it's the most entertaining program on TV.
Like I've been saying all night, you may not think you need help at all when the market seems to be levitating, but in reality, you probably do. When stocks go up, especially when they're up big, people get emotional. And emotions make us bad investors, period. Always does. And that's why the Mad Money Rally Playbook is all about. Helping you combat your intuitive emotional reactions so you can make sound, rational decisions. By the way, we teach this discipline, same discipline, in more detail to members of the CNBC Investing Club every single day as we manage the charitable trust. Remember, when you catch a big up day, that's a selling opportunity, all right? Well, you want to use it to unload some of your best performers, along with your laggards, and the stocks you wanted to get rid of anyway. Also, you can raise some cash for a rainy day. That's the most important thing to keep in mind after a major move higher, which brings me to my final rally rule. At a moment when raising cash is essential, spending cash is absolutely prohibited. After a big one-day move, I know you're going to be tempted to buy some stocks the next day. I know this. Big up days make us more bullish. Investors love to chase rallies the same way dogs like to chase cars. When your last experience in the market was having practically all your stocks produce huge gains, of course you're going to feel like buying. But that's another case where your feelings are leading you astray from good investing. Do not buy stocks after the averages have just spiked. Don't chase. Be smarter than a dog. I want you to take advantage of rallies, but when you buy stocks the day after, the day after they just got marked up big, you're letting the rally take advantage of you. I know you're doing this too. I read it on X, formerly Twitter, at Jim Cramer, all day after every big rally. And that's when people are just most excited. That's when they want to open their wallets and start chasing stocks. Don't do it. I know this sounds like common sense, something any clown could figure out. Say nothing of Cramer fave bozo. But I don't waste your time on the show. Of course you know it's silly to buy the day after a rally or after stocks just had a huge run. You know it right up until the moment when you get swept away by your euphoria, which is a mistake we all make, including yours truly. That's why you need a playbook. You need rules to prevent yourself from getting swept away and making mistakes that you're obviously going to regret later on. So please, if you want to buy a stock and the market's just had a remarkable run, do me a favor and tell yourself you missed it. Just say, darn it, I missed it, and take a pass. Or at the very least, keep your bat on your shoulder and wait for a better pitch at a cheaper price. It's the smartest thing you can do in that situation, and it could save you a lot of pain down the road. Here's the bottom line. I always tell you to buy into weakness and sell into strength. But that really means you need to sell some of your winners at the moment when they're at their hottest. And you probably shouldn't buy anything when the market feels like it's on fire. If you do, your new stock picks will likely be consumed in the aftermath of that fire. And you won't have much to show for all that hard-won money that went up in smoke. Stick to Cramer.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show. My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
Throughout this entire show tonight, you've heard me explain to you how to protect and play your portfolio in a bull market. I love to teach my viewers, but I also love learning from them, which is why I always say my favorite part of the show is taking questions directly from you. Tonight, I'm joined by Jeff Marks, my portfolio analyst, and partner in crime, the CNBC Investing Club. And we're going to answer some of your burning questions. We'll also give you a little inside look at what we do in the club. If you're not a member of the club, you can just scan the code or go to cnbc.com/investing club to sign up. I hope you do. Let's take our first question. Jeff. All right. First up, we've got, when do you recommend investing in an IPO? Now, this one, Jeff, I'm going to let you handle because there's nothing harder.
Yeah, look, I think if you can get in on the deal, that's always preferred, right? But if you are trying to invest in a new IPO, just make sure that the valuation isn't completely out of whack with some other companies in its peer group. One more consideration, lockups, always something to be mindful of. When a company becomes public, oftentimes the employees of the company, the major shareholders, they are restricted from selling stock. Once they become unrestricted, sometimes they'll unload their shares right away. That could create pressure on the stock. So just be mindful of lockups, because if you're a little bit patient, it may lead to a better price.
Right, and I wanted to go to Jeff first, but you have to understand that I get very enthusiastic, and Jeff is to check on me. All the time what happens is so many of these IPOs are so exciting, but that should never dictate why you buy something. Excitement doesn't count. Next up, Andy in California asks, hi, Jim. Can you please explain how investors should view GAAP or non-GAAP earnings? Thank you. This is very complicated. But let's suffice it to say that I like what are known as traditionally, generally accepted accounting principle numbers. In other words, I don't want to hear fancy ways to make earnings when there is a traditional way that I learned in accounting and you learned too.
Sure.
Let's not fool around.
GAAP is gold standard. Right. I mean, at times it is helpful to look at non-GAAP because they'll exclude some one-time items that maybe doesn't give you a great apples-to-apples comparison of earnings. But sometimes we know management teams, they like to take a very liberal view of those non-GAAP earnings. So you have to be careful sometimes around that.
Right, and we don't share the notion of liberal view. There's so many companies out there that have straightforward accounting. Why reach to someone that doesn't? I want to go to Todd in Minnesota, who asks, concerning when to buy, doesn't only buying / adding to a stock when it's below basis dogmatically ensure we miss all momentum runs and only participate in downturns? I missed out on huge runs in the fall because I hesitated to add to partial positions. This is an art, not a science, sir. And what happens, Todd, is that we end up, yes, we're going to miss some. That's absolutely true. But we care more about the downside. If we stop the downside, if we protect against the downside, the upside is going to take care of itself. It is painful for me sometimes, and we've talked many times about how we refuse to violate basis. This is something we fight every day, tooth and nail. But the fact is, we have proven evidence that we've saved more money than we would have.
Yeah, look, I like to apply a strict interpretation when you're just putting a position on over those first couple weeks, maybe months, only because you never know what curveball the market may throw at you. In that case, just being a little bit patient saves you. But in terms of when to violate, well, if you've been owning the stock for a while and you've had a lot of good news come, well, then it's just a better company than from where you first started buying it. So that could cut towards violating.
That is a great way to look at it. A great way. I know that there'll be situations that are missed, but you just heard why we have to stick to our discipline. Next up, we have a question from Karen in New York, who asks, how do we find the RSI, and is it a reliable indicator for making investment decisions? You know, this relative strength index, I do like to look at it, but I'm not wedded to it. And we can find it in various different places. I don't know. I tend to just look at the chart myself.
Yeah, look, you can find it on your trading platform. Keep in mind, RSI, it could signal when a stock may be overbought or oversold, but overbought doesn't necessarily mean sell, and oversold doesn't necessarily always mean buy. At the end of the day, the fundamentals are what matter most, and if a stock is oversold for a long time, it could signal that something is fundamentally wrong.
Very true. And we're looking for entry point. It's a tool. Again, what I find most important about entry point is whether I'm buying it expensively or less expensively. And as far as I'm concerned, RSI, it's just another arrow in the quiver, but not the most important one. I like to say there's always a bull market somewhere, and I promise you I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.